In today's episode, I'll talk about two very interesting stories. In the first story of the day, I'll talk about how and why Vedanta is investing 2 billion US dollars in Saudi Arabia. And in the second story of the day, I'll discuss the insurance sector of our country and we'll understand why it is exactly so underserved today. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy to understand, yet a level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 28th of November. Let's start with the very first story of the day. Vedanta Limited, which is one of India's largest mining and metal companies, has recently announced a big move. They plan to invest 2 billion US dollars in Saudi Arabia. Now, the aim here is to set up a copper manufacturing facility. But what does that mean and why is it such a big deal, you might be wondering? Let me explain. Look, here is the plan exactly. Vedanta is building three things in Saudi Arabia. The first one is a copper smelter. Now, this facility will process raw copper ore and turn it into refined usable metal. You can think of it as taking crude mineral and then refining it to something that is more shiny and a lot more valuable. The second thing they are building is the refinery. Now, once a copper is refined, this plant will remove any leftover impurities and will produce high-grade copper, which is basically copper that is pure enough to be used in high-end applications. The third thing Vedanta is building is a copper rod plant. Now, this is where purified copper will be shaped into rods. And these rods are super critical because they are eventually turned into cables and wires which are used in multiple industries. Now, altogether, these facilities will be massive. The smelter and refinery combined will produce 400 kilotons of copper every single year. The rod plant, on the other hand, will churn out 300 kilotons every year. And to give you a perspective of how big that number is, India's total copper demand currently is at around 1,500 kilotons per year. Now, this means this project alone could cater to nearly half of all of India's needs. But the question here is, why is Vedanta exactly setting up this facility in Saudi Arabia? Now, to answer that, we'll need to take a step back and understand Vedanta's journey. We'll also have to understand the growing global appetite for copper and also Saudi Arabia's ambitions to reshape its own economy. Now look, Vedanta is not quite new to copper. In fact, Vedanta was once at the forefront of India's copper industry. Through its subsidiary Sterlite Copper, Vedanta operated a major copper plant in Tamil Nadu. Now at its peak, this plant supplied 40% of India's refined copper demand and produced 400 kilotons annually. But in 2018, everything sort of came crashing down for Vedanta. The Tamil Nadu plant became the center of a massive environmental controversy. Locals started to accuse it of polluting the air, the water, etc., and it led to months of protests. Now, the tensions here escalated in May 2018 when the police fired on protesters and killed 13 people. The Tamil Nadu government responded by shutting down the plant permanently on environmental grounds. Now, this was not just a blow for Vedanta as you could imagine, it was a massive shock for India's entire copper ecosystem. From being a net exporter of copper, India all of a sudden became a net importer, and we now suddenly relied on countries to meet our growing demand. And to give you context, just last year, India had to import over 275 kilotons of copper. And let me tell you, Vedanta's troubles did not even stop in India. They also faced some challenges abroad, particularly in Zambia. Now, back in 2004, Vedanta acquired an 80% stake in Konkola Copper Mines, or KCM, which is one of the world's largest copper assets. But things went south in 2019 when the Zambian government accused Vedanta of underperformance and failing to meet environmental and social responsibilities. As a result of this, the government seized control of the mines, and this led to prolonged legal battles. Now, Vedanta only regained control of KCM in 2024 after they agreed to invest 245 million US dollars to revive their operations. Now, at this stage, in case you're wondering why copper is such a big deal and why is there so much discussion about it, let me explain that as well. And to understand this in better detail, we will need to know that copper is almost like the backbone of modern energy systems. It has the ability to conduct electricity very efficiently, and this makes it indispensable for an electrified world that we live in today. Let me break it down further for you. See, let's talk about electric vehicles first. Copper is a very important component in electric vehicles. Each electric vehicle uses about 80 kilograms of copper, which is 3 times more than traditional petrol or even diesel cars. Copper is used in everything in EVs, right from the batteries to even the motors and even the charging stations that people visit. The second thing we look at here is renewable energy. Now see, solar panels and wind turbines are copper guzzlers of sorts. To give you an instance, building 1 gigawatt of solar capacity requires 2.4 tons of copper. Now offshore wind farms need even more, up to 13.5 tons per gigawatt. The third thing is power transmission. Look, renewable energy plants are usually built in remote areas which are far away from cities where power is required. So transferring this electricity to the cities requires a vast network of transmission lines which also heavily rely on copper. The next one I'll discuss is urban infrastructure. Now even over here, copper is pretty much everywhere. Think about buildings, appliances, smart grids, etc. pretty much every single place. From wiring homes to creating energy efficient systems, copper is very essential as a material for all of our modern cities. So if I were to summarize this in short, as our world is today moving towards electric vehicles, renewable energy and smarter cities, the demand for copper is sort of skyrocketing. And this brings us back to Vedanta's choice of Saudi Arabia. Why set up a copper facility over there in the first place? The answer lies in Saudi Arabia's bold economic strategy, which is called Vision 2030. Look, today Saudi Arabia earns over 70% of its revenue from oil and gas. But the kingdom over there knows that it cannot last forever. The world is now moving towards cleaner energy sources and Saudi Arabia therefore wants to diversify its economy. Under their Vision 2030, they are investing heavily in sectors like mining, renewable energy and advanced manufacturing. Copper is super central to their plan here, and I'll explain why. The first reason is that Saudi Arabia wants to generate about 50% of its energy from renewables by the year 2030. This means building solar farms, wind turbines, and power grid, all of which need massive amounts of copper. The second one is their global ambitions. Because Saudi Arabia just does not want to meet its own copper needs, it also wants to become a global mining and refining hub. Now the country sits on 1.3 trillion US dollar worth of untapped mineral wealth, which includes copper, gold and rare earth elements. So by partnering with a company like Vedanta, Saudi Arabia is building capacity to process these resources locally and reduce its reliance on imports. The next reason why Saudi Arabia is so interested in this is because of their geopolitical strategy. Look, today China dominates copper refining and handles nearly 50% of the entire world's output. Now this concentration creates a lot of vulnerabilities in global supply chains. Now by investing in projects like that of Vedanta's, Saudi Arabia is aiming to position itself as an alternate hub, and they are aligning with the global China Plus One strategy, which is aimed at reducing dependence on China. Now for Vedanta specifically, this $2 billion project is more than just a business expansion idea. It is shot at also redemption for them. After all the setbacks they faced in India and Zambia that I spoke about earlier, they need a win to re-establish themselves as a leader in the copper industry. And in case you're thinking that India would be at a loss if Vedanta moves to Saudi Arabia, this partnership could actually be a game changer instead. See, with Vedanta's facilities in Saudi Arabia, India might also gain access to a more stable supply of refined copper. This could reduce our reliance on imports, particularly from countries like China, and could also provide a boost to critical industries like electric vehicles, manufacturing, and renewable energy. So by now, I'm sure you understand that copper is no longer just a commodity in our world today. It has now become a strategic asset. With demand projected to grow by 40% by the year 2040, the stakes today are higher than ever. The question is, will Vedanta and Saudi Arabia succeed in reshaping global copper markets? Only time will probably tell, but one thing is certain over here. As people who track the markets and maybe even invest, this is a sector that we all need to keep an eye on. Now with that, let's move on to the second story and explore the curious case of Indian insurance. We'll understand why it is so expensive and so underserved in our country. Look, whether it is life, health or general insurance, almost all of us today know that we should have it. But the thing is, we don't give it much of a thought unless something actually goes wrong. And in an odd case where we look at it, there is always this nagging question which says, why is insurance so expensive in our country? And if you've ever glanced at the stock prices of insurance companies, you also might have noticed how shockingly high their valuations are. These companies are trading at 50 times, 80 times, or even sometimes 100 times their earnings. And that, for your context, is way higher than most other industries. But still, when you look at the insurance penetration in our country, the percentage of people or GDP covered by insurance is embarrassing low to say the least. So the question is, what's exactly happening here and why are these companies so valuable if the industry itself seems so sluggish? Let me break it down from the very basics for all of you. Look, you can think about insurance as a safety net of sorts. You pay a small sum, which is called a premium, regularly, and in return, the insurer promises to cover big, unexpected costs like hospital bills, accidents, or even property damage. Now, for a country like India, which has a massive population of 1.4 billion people, you would think that insurance would be a booming industry. And it does show promise for sure. Some analysts predict that this sector could grow at 12 to 15% annually over the next few years. And that is a huge growth rate. But the catch here is that despite all of this potential, the Indian insurance sector remains shockingly underdeveloped. As of 2023, the insurance penetration of India was just 4.2%. And to put this into some perspective for you, the global average is 7.2%. Even if you look at emerging markets like South Africa or Brazil, they hover around 5 to 6%. Developed countries, on the other hand, like US, Japan, etc., are much, much higher. And India's numbers look particularly bad when you realize how little we have changed over the years. Back in 2001, when the sector first opened up for private players, insurance penetration was at 2.7%. And today, after 23 years, it has moved to just 4.2%. And that is just painfully slow progress. So the question here is, what exactly is stopping our country from catching up? Look, there are a few key issues here. Some are cultural, some are structural, and some are also regulatory. Let me quickly give you a rundown. Let's first start by understanding the cultural mindset. See, in India, insurance is not quite a priority as such. Imagine you're trying to sell insurance to someone. You're basically asking them to pay money today for protection against something that might never even happen. And even if it does, it could be decades away. And that, of course, is a very, very tough sale to make in a country like India, where many people are focused on immediate expenses like food, education, and housing. In Western countries like Germany, governments have sidestepped this issue by making insurance absolutely mandatory. For example, every German citizen must have health insurance. But in our country, India, insurance is still perceived as a luxury and not really a necessity. And that brings me to the second point, which is high entry barriers for business. See, starting an insurance company in India is not at all easy. To begin with, there is a minimum capital requirement. To set up an insurance business in the first place, you require at least 100 crore rupees in capital. And that, by any stretch of imagination, is a huge amount of money for any new or niche player. The second hurdle is foreign investment limits. See, while foreign insurers are definitely allowed to invest in Indian companies, they haven't always had the freedom that they would like to have. Until very recently, the FDI in Indian insurance was capped at 26%. Now, even though now this limit has been raised to 74%, many global insurers still hesitate to enter our country. They would rather have full control over their operations, which isn't currently allowed. The third hurdle is that in India, insurers must choose between life insurance like LIC or general insurance like health, motor, or fire insurance. They can't quite legally do both under a single license, and this limits what companies can offer even if they already have a customer base. Now, remember how I mentioned there are also regulatory bottlenecks with respect to insurance growing in India? Let's talk about that as well. See, even if you manage to start an insurance company somehow, the rules are all stacked against you. There is solvency ratio, which means insurers must maintain a solvency ratio of 150%, which means they require at least 3 rupee in assets for every 2 rupees in liabilities. Now, while this definitely ensures financial stability, it does not quite consider the actual risk that an insurer is taking on. A company with low risk policies is pretty much treated as the same as the one with high risk policies. There is also GST on premiums. Insurance premiums are taxed at about 18% GST, which makes them even more expensive for customers. And this further discourages people from buying insurance. And all of these problems have resulted in very limited competition in India. In our country, we just have 59 insurance companies, 27 for life insurance, 25 for general insurance, and 7 for health insurance. Now, for a country that has 1.4 billion human beings, that is absurdly low to say the least. If you want to compare this to the US, they have 5,900 insurers for a population of just 330 million. But there's also good news here. The Indian government and the Insurance Regulatory Development Authority of India, or the IRDAI, are now working on reforms to fix all of these issues. So while we are at it, let me very quickly take you through some of the proposals that are currently under consideration. The first one is about lowering entry barriers. See, the IRDAI wants to reduce the 100 crore rupee capital requirement and allow smaller specialized insurers to enter the market now. For instance, a company could focus solely on agricultural insurance in a specific region without requiring massive upfront capital. The second thing is 100% FDI in insurance. See, the government is considering allowing foreign insurers to own 100% of Indian insurance businesses. And this could attract global giants like Berkshire Hathaway, etc., which could bring in more competition and also innovation. The third thing they're proposing is composite licenses. Look, insurers might soon be allowed to offer life, health, and general insurances all under one license. Now, this of course could help companies cross-sell products and could also provide more options to customers. The fourth proposal is risk-based capital requirements. See, the solvency ratio could be replaced with a risk-based system where capital requirements depend on the actual risks an insurer takes on. This would make it much easier for insurers to grow while also maintaining financial stability. So if I were to summarize things for you, I would put it this way. The Indian insurance industry is almost like a teenager with a lot of untapped potential. It has all the ingredients for success, but it hasn't quite figured out how to grow up yet. Cultural barriers and regulatory challenges have held it back for many decades now, but now with the right reforms coming into the picture, things could change very quickly. But it's still very important for all of us to keep our expectations realistic here. Even if the reforms are approved, they will take a lot of time to implement. Changing mindsets, building trust, and even creating a competitive market are very long-term projects. For now though, India's insurance industry still remains like a paradox. There is huge potential, but there is painfully slow progress. Now let's move on to the final section of the day and talk about the quick news tidbits. First, once a company that was valued at 22 billion US dollars, Baiju is now under a federal investigation for alleged misuse of funds. This comes after insolvency proceedings plunged the company into disarray. Founder Baiju Ravindran has admitted that the company's valuation has effectively dropped down to zero, which has shaken investor confidence in Indian startups overall. Second, the Employees Provident Fund Organization or the EPFO plans to reinvest 50% of the proceeds from ETF redemptions into equities. This move is aimed at boosting returns for its 70 million subscribers. In addition to this, there is also a proposal to extend the redemption timeline to 7 years, which signals a shift towards long-term investment strategies. Third, India shipped 4.49 million personal computers in Q3 of 2024. This was driven by festive online sales and rising demand for premium notebooks. HP continued to dominate as the market leader here. An interesting trend here is that desktops saw an 8.1% decline in shipments, which reflects a growing consumer preference for portable devices. Well, that's all the news and stories I have for you today. I hope you enjoyed this show and maybe learned something new also today. As always, if you have any feedback or anything at all to share with us, please leave a comment down below and we would love to interact with you. This was the Daily Brief Show by Zerodha. I'm your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.